Welcome everybody to this week's analysis session. Today is the 12th of March 2015. Our standard disclaimer: this week's presentation is intended for educational purposes only and does not constitute personal financial advice. On the agenda for today, on the economic front, we look at US jobs data that came out last Friday, and then also look at its impact that it's had on the US dollar and global markets as well. We've had Aussie jobs data out today, and also Chinese trade data over the weekend, so we'll talk about all of those. They're the biggest things to hit the markets this week. Portfolio wrap, you can see those codes there. We've had some news on, so we'll talk about each of those bits of news. And today we're going to look a little bit at GMA. We sent a text message for the stock a couple of hours ago, exiting the stock and locking in a small profit on the position. We'll talk about our rationale behind that. So on to the economics. And really the big story over the last week has been the US jobs data. Now this comes out every month, and on its own, or certainly it impacts markets on the day when it's released and sometimes for a few days afterwards. But this month the US jobs data had extra significance. So the data showed that 295,000 jobs were added to the American economy in February. This was way ahead of expectations of a 240,000 job gain. Interestingly, it's the second best result since June 2010, with the best result coming within the last few months. So really a couple of big solid months of job growth in the US, and that's really good news, right? And should push the US market higher. Instead, it's had the inverse effect, where in the US we're kind of in a bad news is good news, and good news is bad news, in which that really sort of fits into. So the reason behind this is that with the jobs market improving, the market is now expecting, the financial market that is sort of speeding up and increasing its expectations that the FOMC, that America's reserve, essentially part of the Reserve Bank in charge of setting interest rates, is going to bring forward, or at least sort of speed up its first rate hike. Basically, the market is expecting the FOMC to drop the word patient from its statements next week, which Chairperson Yellen has already sort of flagged, or at least hinted at, and now the market is basically fully pricing in a rate hike by June. So what we've got is good news on the job front, basically being interpreted as bad news, because that means interest rates are going to start going up. And so that really, with interest rates going up, we should know that higher interest rates lead to an appreciating currency. So the US dollar has really been the story of the week. It's taken off in the last week. The dollar index, so this is comparing the dollar not to a single currency, but compared to a basket of currencies. So in a sense, sort of averaging out how the dollar's gone against the euro and yen and Aussie dollar and Swiss, etc. And that dollar index is up to 3.6 in the last week, which is a really big jump for the US dollar. Part of that has been really influenced by euro weakness. And in the meantime, the Aussie dollar's fallen 2.6%. So while it looks like the Aussie dollar has been smashed in the last week, and we're now below 76 cents, and we are at fresh multi-year lows. So not denying that, certainly the Aussie dollar has fallen, but if it hasn't really been because the Aussie has been particularly weak, it's because the US dollar has been particularly strong. The US dollar index is now at 11-year highs and has put on about 25% since this financial year, since the end of June 2014. So obviously, the markets are really pricing in and building up ahead of this expectation of the first rate hike. So on top of that, not only did the US dollar go up, but US markets took a hit. Obviously, markets really like low interest rates. They don't get much lower than they are in the US. So whilst rising interest rates are and strong jobs numbers are in theory or technically positive news for an economy, obviously financial markets can take them a bit negatively because they don't really like rising rates. Just a bit of a tidbit. I think I mentioned this in a webinar early this year, or maybe late last year, that typically in the US, when they have started a rate rise cycle, you do tend to get a pullback in the stock market in the 6 months sort of leading up to the first rate hike, or 6 months surrounding, because obviously the market is adjusting to the rate hike, but over the next few years the market tends to perform fairly well, because ultimately if the economy is strong enough to put rates up, it's really good news, even though it's sort of bad news for investors. This over in sort of towards this neck of the woods, in the last week we had Chinese trade data which came out with a surplus of $60.6 billion US dollars for the month of February. It's the highest number on record. The numbers were impacted somewhat by the Chinese New Year, so you have to play around with the numbers to try and because Chinese New Year obviously happens a different day or different week each year. Last year it was in January, this year in Feb, so it sort of plays around. So what we've done is we've taken January and February and put them together to kind of balance that out. Exports were up 15% on this time last year, imports down 20%. So it's a good sign that China is exporting more goods, mostly to a lot of that growth's coming from the US. And in terms of imports, in the past, falling imports in China sometimes shows slowing economy over there. There's less demand, they need less goods to produce what they need, although this is really just a reflection of falling commodity prices, in particular iron ore. So they're still buying as much iron ore as they have been, just that the price of iron ore, the dollars they're spending on it, is falling significantly. The trade data, look, it's not game-changing, but it's certainly some good news, especially since we've had the Chinese Premier come out recently and say they're targeting 7% GDP growth this year, which is the lowest in a very long time. Certainly, whilst the surplus data is positive, given the GDP forecast, we'd expect that the Chinese are still going to be maintaining fairly loose monetary policy, so they're still looking to basically stimulate over there. I don't think this is, even though it's really good news, I don't think it's going to change their minds and force them to put up rates or anything like that. Speaking of data impacting rates, we had our own jobs data this morning. 15,600 jobs were added in February, which was almost exactly in line with expectations. Interestingly, the majority of jobs, about 2/3, were full-time, which is a big positive. Obviously, full-time jobs add more income and taxes and spending than a part-time job. The unemployment rate did dip to 6.3%, mainly because the participation rate fell, so less people were looking for jobs, so less people were unemployed. This doesn't really change anything. Obviously, I mentioned it's as expected. It's slightly positive that we've got some jobs being added to the economy. It's not such a huge number that a positive number is better than a negative number, but it's not so many jobs that it's a really meaningful stat, and it's unlikely this would change what's going on in the RBA's mind, which at the moment we predict is probably another rate cut in May. The market's still pricing in a good chance of a rate cut next month, but we're sticking to our guns, and the RBA's track record of cutting in Feb and May, August, November, by far its most common months. I don't think the RBA's in a mad rush to cut again. and this doesn't really impact that. Looking at our portfolio, the market is down, or just generally the Aussie market is down 1% since the last update, really on the back of a couple of bad days in the US reacting to this expectation of rate hikes. US market got smashed a couple of days. We sort of took a hit, and we've bounced back a little bit. Also, ex-divs, companies going ex-div have taken the heat out of the market a little bit. So when a company goes ex-div, its share price generally falls. And also the high US dollar has pushed commodity prices lower, so our mining sector's been under further pressure. Looking at our portfolio, AWE announced late last year that AWE made a major gas discovery in WA. It's just completed some flow testing and decided that the discovery is commercially viable, and it could be in production by as early as next year. The company's going to conduct some further testing in the next month, but that is definitely a positive for the company. ASB, it's fairly minor news. They've delivered another Cape class boat. They had eight vessels that they were building for customs and border protection. This is the fifth one of those, so a bit over halfway through the contract, with the rest to be delivered by the end of the year. DNA has secured $100 million US in funding from a Taiwanese bank, Mega International Commercial Bank, which is a real bank, despite the cartoonish name. And so that's obviously funds are going to be used to pay for its recent acquisition in Cambodia. FMG is looking to refinance $2.5 billion worth of debt, looking to pay off debt that's set to expire in the next 4 years and push it out. So basically looking to push back its repayments to give it a bit of breathing room while the iron ore price is getting pummeled. And then obviously the company is hoping that by the time it has to pay back the debt, iron ore price will be higher and the company will be generating more money. GBT has been added to the ASX 300 index. That's effective at the end of next week. Same for VLW has been added to the ASX 300. A couple of ex-divs during the week. BHP went ex-div for 62 US cents, or about 79 Aussie cents. And ASB went ex-div for 1 cent. Upcoming issues, news affecting the portfolio. MQG, Macquarie, has their share purchase plan ending in about a week and a half. Currently the share price is a couple of dollars above the SPP price. We're quite bullish on MQG shares at the moment, so our current intention is to take up the entitlement, but we'll provide an update next week. Next week's webinar is probably perfect timing, about 5 days out from that ending, so we can make a call on buying, on taking up that SPP. But at this stage, we'd be planning to take up the maximum $10,000 entitlement. All right. Next in line for this week, actually the last thing to really discuss, is GMA. So we sent an SMS to exit this stock earlier today. We've covered the stock a couple of times in the last few weeks. One of those was looking at its recent results, and the recent results were really strong. Actually, the share price jumped up around 20% or 15-20% on the back of its results. You can see their profit was up, underlying profit, gross written premium rose, a little bit weaker than expected though. Loss ratio was down. They announced a really nice juicy dividend. So the results were really strong, but shortly after their results, it was revealed that Westpac, one of its main customers, Westpac has decided to take its business away from Genworth and decide to source mortgage insurance offshore, where it can get that service cheaper. So the results were good, but a key contract loss has sort of basically balanced that out. Sort of discuss those. The results were very good. Really strong dividend with a special dividend too. Based off our calculations, ignoring the special dividend, the stock's yielding about 8%. Strong capital adequacy, so it's got plenty of money in the bank to withstand shocks. And looking forward, business should be pretty good for GMA. Low rates are supporting higher borrowing, although we're seeing some less people sort of invest, borrowing, 90+%, borrowing on small deposits, and APRA is also looking at further limiting investors borrowing with small deposits. So, put together, the contract loss and potential regulation change just provide a couple of clouds essentially over GMA. The risks are increasing. As you can see there, Westpac's contract was about 1/7 of GMA's business. Now the stock fell by more than that, so its sell-off was probably overdone, and probably a little bit. The sell-off sort of initially looked to be quite exaggerated. The stock is trading on a P of around 8 times and a yield of about 8%, which is roughly, it's a little bit more expensive than where it was when we got in last year. So in theory, the stock is still fantastic value, even given the risks that face it. But the market's in my opinion, the market's pricing in another contract loss. So there's sort of increasing talk that the banks are going to continue to offshore their lenders' mortgage insurance. Particularly as the banks are not seeing a lot of top-line growth, they're looking to cut costs, and this is a fairly sort of obvious area that they could pursue. So yeah, it's obviously an increasing risk there. So I guess summary is for this one that the stock still offers strong value, but the risks are increasing. So we've exited the position for safety. I wrote actually one of those bottom points is that the stock is really struggling to rally despite the flight to yield. So we're seeing investors run towards banking and financial stocks, and GMA is just not. Sorry about that. Trigger happy finger there. Investors are not rushing towards this stock, which is a bit of a worrying sign. So decided to exit that. We bought the stock in June last year, so we've held the stock for 9 months. We bought in at $3.08. We exited today at $3.28, and if you include some dividends along the way, it's returned about 15.3%. So a sort of smallish profit there. Certainly were looking at a much bigger profit before this contract loss, but look, I guess that's somewhat came out of the blue, and we don't want to get caught if something like that happens again. So getting out of the stock, locking in some profit, and despite this trade ultimately turning out to be somewhat disappointing, we've still managed to make some money, which is I guess at the end of the day a good result. Where to now? That's it for today. The slides, if you want to access them, will be uploaded shortly. If you have any further questions, please email us at support@elitewealth.com.au. We've had a few more clients write in the last week or couple of weeks with just some more questions about positions and the webinars. So I'm obviously always happy to get client questions and feedback and get back to you guys. So encourage you guys to get in touch if there's any more information you need. Otherwise, that's it for today. Thank you very much for listening, and have a lovely end of the week and weekend, and I'll catch you again next week.